Hi there, I'm Jennifer Lee, Senior Economist at BMO Capital Markets. Well, it's been a very rough start to 2016, but global financial markets seem to have found some semblance of calm over the past couple of weeks at least, and that should help quiet talk of a U.S. recession, and that in itself will help also mitigate the chances of a U.S. economic recession. This calmness was brought about by two factors. Number one, oddly enough, oil prices, and I say oddly because lower oil prices should be good news for consumer spending. But oil prices seem to have found a footing around a $33 mark. That's just due to chatter by various OPEC members, Russia, Saudi Arabia, potentially freezing production levels at the January level. Secondly, and more encouragingly, has been on the U.S. economic data front. And I'm not talking just about the upward revision to fourth quarter GDP. Some of the monthly data have actually started the year off on a stronger note, namely business orders for durable goods, business shipments of durable goods were pretty solid in January. There was a 0.4% pop in U.S. real consumer spending. Definitely great news to start off the year, especially given that we all know, given that consumer spending takes up about 70% of the U.S. economy. So that's all good news, and that should also pave the way for the U.S. Federal Reserve to continue raising rates this year. We see the Fed tightening again in June and again in December. This economic improvement will probably be coming along in fits and starts, but again, overall, I think the trend was definitely upward. The story is a bit different in Canada. Now, let me just take you back to January. The Bank of Canada was expected to cut. They did not, and that was mainly due to the Canadian dollar, which at that point was almost seemingly in free fall. The Canadian dollar has steadied itself. It's actually rebounded to about 74 cents lately. And that in itself, of course, is good news, but the data remain quite weak. And because of that, we expect the bank to cut rates again in April. Now, the one event that could possibly stop the bank from cutting is coming from Ottawa. If the federal budget, which is going to be tabled on March 22nd, if the federal budget really reveals some massive stimulus spending on infrastructure, that could be enough to take some of the pressure off the Bank of Canada, but we shall see. So all in, just again, good news that markets have seemed to have calmed down, and that will help pave the way for more Fed rate hikes. But the Bank of Canada, we can't count them out yet with another rate cut. Thank you.